It's always exciting for me to talk about the rise of index investing, the rise of passive management, in part because it's in the history of financial history, it's very new. All of this took place within the lifetime of most of us listening today. Now, I'm sure there are some who are too young and don't remember that, but let me give you just to set the stage, an indication of what I call here some professorial suggestions, and these were taken from one book and one article written in the mid-1970s. A particular reason why it happened then, which we can talk about later. But I show you these just to illustrate the way in which indexing has evolved over the years. So the first one is a quotation from a pretty well-known book called A Random Walk Down Wall Street. I think it's probably on the 14th or 15th printing now, but the first edition came out in 1973. It's basically a how-to guide for individual investors. And Bert Malkiel says, sort of at the end, he gives an inventory or list of mutual funds and suggests some things that investors ought to think about in using them. And then he says, what we really need is a no-load, minimum fee fund that just buys all the stocks on the market. Basically saying, somebody please start this. And then a year later, Paul Samuelson, I think only a year or two after he won the Nobel Prize, said basically the same thing. It was an article in the very first edition of the Journal of Portfolio Management, in which he said, some foundation, please just do this. Somebody track the S&P 500. You don't have to invest in it if you don't want to, but at least we'll have a way of understanding how active managers are doing and whether they are or are not adding value. Well, that's the 1970s. Now fast forward 40-some years, and this is a graph that we update every year. It's simply the assets tracking in passive trackers that track the S&P 500. And you can see it amounts current, as of last year, it's certainly higher now, roughly $3 trillion. That's just the S&P 500, not the mid cap, not the small cap, not our competitors. And that, interestingly enough, the total value of all the capitalization of the S&P 500 is about $20 trillion. So $3 trillion is roughly 15% of the total. So that's one measure of the success that the professors had in their urging so many years ago that somebody should just start a passive portfolio so people can invest in it. Now, why did it happen that way? And that's what we want to talk about today. There are really four things to mention, and you can tell from looking at this slide that I was kind of in an alliterative mood when I wrote the title slide. One is what I'll call an inexorable influence that we'll talk about. Secondly is a transient trend, or possibly a transient trend. It may not be transient, but possibly a transient trend that we'll discuss. Thirdly, we'll talk briefly about index innovation, sometimes called smart beta. And finally, we'll talk about the skewness in stock returns, which I think is an underappreciated but important reason that accounts for the difficulties that active managers have had in adding value. So starting with the inexorable influence, let me show you some data from what we call our SPIVA report. SPIVA, S-P-I-V-A, stands for S&P Index versus Active. We've been doing this in the U.S. Since 2001. This is the most recent U.S. update. What we do in SPIVA, for those of you who haven't seen it before, is to look at actively managed mutual funds and then ask the question of all the large cap funds, for example, in the U.S., how many of them outperform the S&P 500, how many of the mid caps outperform the mid cap 400, small cap the small cap 600. So as nearly as we can make it, it's apples to apples comparisons. This is the most recent update we have through June of this year. The year ended June 30th. In the U.S., about 57% of the large cap managers had underperformed the S&P 500, a little bit worse for mid and small cap. If you go back in 5 years at a time, or if you go back 10 years, as we can in the U.S., the answers are quite similar. If we come to look at Canadian data, we've been doing Canadian SPIVA not for quite as long a period, but the results are quite similar. In the year ended June 30th, 2/3 of all Canadian equity managers had underperformed the TSX Composite, and for the 5 years, 75% had underperformed the composite, which is the answer to the quiz question that we asked at the beginning, of course. Only 25% had outperformed, and it's, by the way, this is not unique to North America. We do SPIVA all over the world, wherever we can find a proper database of funds, and the results are very similar. Most of the time, most active managers underperform, which, of course, is the thing that is the inexorable influence that propels money from active to passive strategies. Now, it is often argued, or sometimes argued anyway, by active managers that the SPIVA data in the U.S. and everywhere, really, for the most part, have occurred in a time of rapidly rising stock prices. We started in 2001 in the U.S. Obviously, the market's been up very strongly since then. What has that meant, or otherwise? But perhaps in down markets is when active managers will really prove their value. And so what we could do with our SPIVA data is to look. Unfortunately, I can only do this in the U.S. because I don't have data back far enough anywhere else. But we could look at the distribution of years. And so what the bar graphs we're looking at now show on the right side are the percentage of underperformers when markets are bad, markets are down. There were only 3 bad years in this period of SPIVA that we have SPIVA data, so 2001, 2002, and 2008. In contrast, on the left side, there were 9 years when the U.S. market was up more than 10%. So what you see is a slight difference in when the market's up big. 66% of active managers underperformed on average. When the market's down, only 63% had underperformed. So it's a little better, but it's still not very good. So the notion that a down market will bail out active management doesn't necessarily fit with the data we have. Now, what you will see in down markets is a greater spread or an increased spread between the performance of the best and the worst active managers. What you're looking at here is, again, it's an excerpt from large cap SPIVA. It's the interquartile range, so the break point for the 25th percentile minus the break point for the 75th percentile, roughly speaking, the best managers minus the worst managers. And what you can see there is quite a strong relationship. As markets go down, the spread between the best and the worst tends to go up. What that means, the way I would interpret those numbers, is to say that if, in fact, an active manager can raise cash in advance of a bad market, he has a good opportunity to add value and to do a lot better than the active managers who don't raise enough cash, and that's what you see on the right side. Unfortunately, not enough of them do it, which is why the majority still underperform. So that's kind of a different take on SPIVA data. The other thing that's worth pointing out as people reflect on SPIVA, the other thing that's worth pointing out is that people often say, well, of course, not all active managers can outperform all the time. It's certainly possible for a particular active manager to be consistently above average. And so we examine that question in a companion to SPIVA that we call the persistence scorecard. What we're looking at here is, again, data from the U.S. What we did is go back 5 years in this illustration, go back 5 years, and said, okay, let me take all of the managers who were above average 5 years ago, and then ask how many of them were also above average 4 years ago, 3 years, 2 years, 1 year, and so forth. And so we've just asked the question, how predictive, how consistent is success? And what you see here is that among all the managers pictured, roughly 4 to 5% are consistently in the top half. By the way, the probability of flipping a coin and getting 4 heads in a row is 6.25%. So I always tell people, when you look at data like this, what it's telling you, or what they're telling you, is that you have a better chance of flipping 4 heads in a row than you do of finding a manager who will be above average 4 years in a row. If you want to expand the time frame over which the consistency analysis is done, we can do that quite easily. What we've done here is to go back 10 years and ask the question, let's take all the guys who were in the top quartile in the first 5 years and ask how many of them were also in the top quartile in the second 5 years. Now, if there were no relationship between past performance and future performance, you would expect 25% to repeat in the first quartile because it would all be random. In fact, what you see across the capitalization range is somewhat less than that. 20% of the large cap managers underperform rather 20% of the large cap managers repeat in the top quartile. Slightly more than 20%, 20.86% move from the top to the bottom. In fact, we see that quite consistently across the range. There is a better chance that a manager will move from the top to the bottom than that he will remain in the top. So it's another piece of evidence that active outperformance, when it occurs, tends not to persist. Now, the obvious question is why? Why? Active managers are smart people. They work hard. They have access to good information. Why is it that they're so challenged when they try to achieve above average performance? And the reason, this is the inexorable influence to which I referred earlier, the reason is that there is no natural source of alpha. What I mean by that is that there is no natural source. I'm using alpha loosely. There's no natural source of outperformance. If we're all investing in a particular market and I'm going to be above average, somebody else has to be below average. If we group all the winners together, all the outperformers together, the weighted average sum of their outperformance before costs is exactly equal to the weighted average sum of the losers' underperformance before cost. Otherwise said, the source of the winner's positive alpha is the loser's negative alpha. Professor Sharp summarized that in an article published in the FAJ in 1991, a great article called The Arithmetic of Active Management. I recommend it to everyone. And which he said, look, investment management, professional investment management is a zero-sum game. After costs, the return on the average actively managed dollar must be less than the return on the average passively managed dollar. It's simply arithmetic. Because there is no natural source of alpha, my positive alpha has to be offset by your negative alpha. Now, the point I want to make in extension of this is that it's going to get worse, in my view. And the supply of alpha is going to shrink. Let me illustrate why I say that with kind of a simple example, stylized, but I think it says something important. We've posited a market with a total size of about $20 trillion, and in scenario A, we've assumed all of it is actively managed. So this is the world 50 years ago. Everybody's actively managed. So 20 trillion actively managed. Since there's no natural source of outperformance, if 10 trillion is going to be above average, 10 trillion must be below average. And so if we ask in scenario A, what is the supply of alpha, the answer depends on how badly the underperformers do. So we have to make an assumption about the average underperformance of the underperformers. I assume for purposes of this illustration, it was 5%. 5% times 10 trillion is $500 billion. And so in scenario A, the winners will fight over $500 billion of outperformance. That's the supply of alpha. In scenario B, we change two things. The first thing we change is that we provide a passive alternative. Now we've said only 90% is actively managed, 10% is passive. So 18 trillion active, 9 trillion above average, 9 trillion below average, 2 trillion pays low fees, gets the average and goes home. And the question now, the critical question is, in scenario B, what is the average underperformance of the losers now? And the argument I want to make is that whatever it is not as bad as 5%. Why is that? Well, when you provide a passive alternative, who loses assets most? Is it the most capable active managers or the least capable? And I would argue, in a rational market, it's the least capable active managers who lose the most value. So the average ability of the surviving active managers goes up. The herd has been culled in some sense. And so when that happens, the underperformers underperform by less. I assumed here it was 5% before, it's 4% now. So 4% times 9 trillion is 360 billion. So hypothetically, with all the assumptions we've made, we've seen how a 10% reduction in active assets under management leads to a hypothetical 28% reduction in outperformance. What that means is there's even more incentive in scenario B for somebody to move from passive to active because there's less, from active to passive rather, because there's less outperformance to be had. We'll come back to this at the end of my time with you, because it's a simple scenario. We can make it a little more complicated and a little richer. But that's the end of the first section I wanted to talk to you about, the inexorable influence of the zero-sum game, moving assets from active management to passive.